Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at the effect of interest rates on bond prices. There is an inverse relationship between interest rate and bond prices. If the interest rates go up, the bond prices go down. And if the interest rate goes down, the existing bond prices go up. And we'll find out how they correlate. Let's say, for example, you are buying $10,000 worth of a 10-year treasury bond where you get a certificate and it says what the interest rate is. For example, it could be 0.5%. That's what it was just a few months ago. Or it could be 1%, or it could be 5%. Depends upon. And we're going to look at actual charts from the stock market and see how they correlate the interest rates and the bond prices. So let us begin. Here is an actual chart as of today. The 10-year treasury bills, which actually went up by 2 points. Let's look at two focus points on this one, and then we're going to correlate with real numbers and see how they relate when it comes to interest rate versus bonds. So here's your 10-year treasury, which was down to almost 0.5% interest somewhere along July 20. That was right after the market crash. And today the interest rate is 1.75%. That is almost like 3 times what it was back in July 2020. So the interest rate has gone up, and now let's see what we can do. Okay, let's assume for a moment that you bought a $10,000 worth of July 2020 treasury bill at interest rate 0.5%. But today, the interest rate is 1.75% for the same 10-year treasury bill. That means nobody is going to buy your treasury bill for the same money you gave, because if they go and buy a new treasury bill in the market today for $10,000, they will get 1.75% interest. So why would they ever buy your treasury bill for an interest return of 0.5%? So in order for you to sell your bond, this is the bond, your bond value is $10,000, but it brings in only 0.5% interest. But if you want to really sell it because you need that money for some urgent need, then you have to sell it in the market. And when you try to sell it in the market, you're not going to get $10,000 which you paid, because for the $10,000, I can go to the market and get 3 times more interest compared to yours. That means you had to sell your treasury bond for a loss. That's how, when the interest rate goes up, the treasury bond prices go down. And let's look at a chart of a treasury bond here. And this is a sort of a bond fund. You're not just going to find, you can find treasury bills alone, $10,000, but I'm just correlating this with a bond fund to give you an idea as how the interest rate and bonds move in opposite directions. And here is like PEMCO, a bond trade fund. Back somewhere in July, the bond prices were high because the interest rate was low. How can the bond price be high? Because the interest rate was low, the bond prices have gone up as the interest prices were coming down. Let's go back to the chart again. As the interest rates were dropping, now people were getting higher rate for the same $10,000 treasury bill compared to when they were here or back here in July. So the bond prices went up. However, from July onwards, if you look at here, July onwards, the interest rate is climbing. And as the interest rate is climbing, people can go and buy the same 10-year treasury for a much better interest rate. As a result, those people who bought their treasury back in July had to sell it for a loss, and that's why the bond prices keep coming down. And now back here in March, if you look at the top here, it was like 112, and this is 109. So there's a significant, the top was like 113.22. Today, the market price is 109.79. So there is a dramatic drop of almost 15% drop in the bond price from July 2020 to March 2021. So the basic concept is your treasury bill is, face value of the treasury bill is $10,000 in both cases. But when the interest rates are low, the treasury bill will lose its value as the interest rates go up. But on the other hand, like we saw in the early stages when the interest rates were, when the interest rates were high, like back in March 2020, and when somebody bought the treasury bill, as the interest rates keep going down, now everybody wants to buy your treasury bill because your interest rates were higher. So they are willing to pay a premium price. And that's what's reflected in the increase in the bond price before July 2020. So this is a quick explanation of how interest rate and bonds work. There is an inverse relationship between the interest rates. If the interest rates keeps going up as it is doing now, from 0.5 to almost close to 2% now it's going to get from what the experts say. So the bond prices are going to continue to go down. I hope this has been educational to you, and please do subscribe to our channel, and we'll see you next time. Thank you so much.